What if I told you that banks don't make most of their money from your savings account? In fact, the thing banks love most isn't your deposits, it's your debt, your mortgage, your car loan, your credit card balance, your student loan. Every day, millions of people wake up determined to get out of debt. Meanwhile, the entire banking system is built around lending money. So why do banks love debt so much? And if debt is so profitable, what happens when everyone suddenly stops borrowing? The answer reveals one of the most important truths about how the modern economy works. Because debt isn't just a financial product, it's one of the engines that keeps the global economy moving. And once you understand why, you'll never look at a loan the same way again. The day Jake bought a car. Imagine a 28-year-old named Jake. Jake needs a car to get to work. He finds a car he likes. The price? $30,000. Jake doesn't have $30,000 sitting in his bank account. Most people don't. So he walks into a bank and applies for a loan. Within a short time, he's approved. Jake drives away happy. The dealership gets paid. The bank now has a customer. Everyone seems to win. But here's what most people don't realize. The bank didn't lend money out of kindness. The loan is now an asset for the bank. For years, Jake will make monthly payments, and every payment includes interest. That's where the story begins. Debt is a product. Most people think of debt as a burden. Banks think of debt as a product. Imagine a shoe company. Its product is shoes. Imagine a smartphone company. Its product is phones. For banks, one of their most important products is loans, mortgages, business loans, auto loans, credit cards. These loans generate income through interest payments. The larger the loan portfolio, the more potential income a bank can generate. That's why lending is such an important part of banking. Without borrowers, banks would look very different. The billion-dollar business of interest. Now let's talk about interest, because this is where debt becomes powerful. Imagine lending someone $100. If they repay exactly $100, you've earned nothing. But if they repay $110, you've earned interest. Multiply that concept by millions of loans, millions of customers, millions of monthly payments. Suddenly, those small percentages become enormous sums of money. That's why interest is so important. Not because a single loan generates massive profits, but because banks operate at enormous scale, and scale changes everything. Why the economy needs borrowers. Here's where things get interesting. Debt isn't only good for banks, it's also part of how economies grow. Think about a family buying a home. Without a mortgage, many people would never afford one. Think about an entrepreneur opening a business. Without financing, that business might never exist. Think about a company building a factory. Without borrowing, expansion could take decades. Loans allow spending today instead of waiting years to save. That spending creates jobs, growth, investment, and economic activity, which is why borrowing plays such a central role in modern economies. The credit card trap. Not all debt is the same. Some debt can create opportunities, other debt can become a trap. Let's look at credit cards. For many people, credit cards offer convenience, but for banks, revolving balances can become highly profitable. If balances aren't paid in full, interest charges begin to accumulate, month after month, year after year. What started as a small purchase can become much more expensive over time. That's why understanding debt matters, because the same system that creates opportunities can also create financial stress. What happens if everyone pays off their debt? Now let's ask a strange question. What if everyone paid off every loan tomorrow? No mortgages, no auto loans, no business loans, no credit card balances. At first, that sounds amazing, but something unexpected would happen. Bank profits would collapse, lending activity would slow dramatically, spending would decrease, economic growth could slow. Because modern economies are deeply connected to credit, debt isn't just a personal finance issue, it's part of the financial system itself. The real reason banks love debt. So why do banks love debt? The answer isn't because they want people to struggle, it's because lending is their business model. Banks connect savers and borrowers, they provide capital, fund homes, support businesses, and keep money moving through the economy. Debt creates opportunities, but it also creates responsibilities, and that balance is what makes the system work. The truth is that debt isn't automatically good, and it isn't automatically bad. Used wisely, it can help people buy homes, start businesses, and build wealth. Used carelessly, it can create financial hardship. Banks love debt because debt is one of the products that powers modern finance. But understanding how that system works gives you an advantage, because once you understand debt, you stop seeing it as just money you owe and start seeing it as one of the most powerful forces shaping the economy around you. The question isn't whether debt exists. The question is whether you're using debt, or debt is using you.